This is December contract, so we've still got 6 weeks until it starts pricing. And it's got a bit of an open interest way to go, but at the same time, a lot can happen in 6 weeks. If a lot of why you were buying was on the back of a geopolitical sentiment, you should really sell the fact, right, at the end of the day, and that's what people have bought. So I can absolutely see the logic. Hi everyone, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, the Chief Executive of Onyx Capital Group. I'm joined with Vincent and Martha from the research team once again. Just please, before I start, the like and follow, please keep it up because it's really gaining traction, really helps us to know the feedback, what's going on, and obviously helps us as well in general. So, clicking the bell for notifications, and if you can, please comment, let us know your thoughts. We'd love there to be a debate around what we're saying and any questions, of course, happy to answer. So getting straight into it. So guys, we've had another week off the back of the, tense situations. We were talking last week about Israel-Palestine, of course, and bits and pieces. But Vincent, do you want to just give us a quick summary of what's happened since that week, since Tuesday?
For sure. Flat price still above 90. But it seems to be that the market is getting increasingly fatigued, or should I say bored with the lack of headlines. Of course, in the Middle East, the situation seems as if there's going to be some de-escalation, lot of diplomacy going on right now. And on the trading side, although flat price above 90, seems like people are taking some profit on their positions. It's still a very tight market, but we're also seeing things like Brent spreads coming off, the North Sea physical windows getting increasingly offered, whilst WTI exports are increasing once again.
No, it's a good summary. I think that the US is a lot of the story, and we've got more to get on that on the wider market. But I think the interesting things for me with that, we did have this rally last week on the back of the week before, but as the week went on, it just seemed very evident that there's less and less belief that there was going to be this momentum and contagion fears that were actually going to find their way into a real production impacting event. And I think that the sting has been taken out of it, like we discussed last week, and in a matter of just yesterday, a lot of gains wiped out. We're approaching $90 per barrel on Brent. And as you said, the Brent spreads have since taken a bit of a hit, or quite a significant hit. And bear in mind, we're coming up to expiry for the December contract in a week. So it's pretty significant and pretty telling about what the underlying physical is actually saying. That's the great thing about expiry. It actually gives you a good indication of the health. So, $1.20-ish on a physical on the time spread that's about to expire. That's a physical differential that indicates a good strong physical differential, but it was a lot higher. And the other thing that I thought was interesting was the WTI Brent has come off. Now that coming off after such a strong month, the month before, strong WTI expiry, it's a physically delivered contract. People are talking again about the SPR being very dangerously low. Bit of a worry there that US gets too tight. It can't, it's stuck essentially. And to fuel that, we got draws across the board last week, which was really interesting. It was a flip-flop from the week before, which was all builds or mostly builds, and then we got draws, all products, all regions. So that was a bit of a shock, and I thought, maybe there's some bullish momentum that's going to carry through here. But actually, WTI Brent's gotten lower. I think you were mentioning in your notes the US exports have gone back above 5 million barrels a day. They're high. There's plenty of WTI barrels being offered into Europe, into the physical windows. So actually, it looks like for all the hype and all the concern, it's a bit of a US story again from production point of view, from the underlying physical, which was not, we wouldn't expect that. And then you couple that with the refinery margins, which are starting to change shape a little bit. But I think we'll talk about that in a bit. Because Martha, talking about the US, we've got some activity there, or more on the macro side, but that's actually quite interesting and feeding a little bit into what we're saying. So do you want to give a bit of a summary there?
Yeah, of course. So the main story this week is we've seen two really large oil and gas mergers and acquisitions. ExxonMobil acquires Pioneer. They're doubling down on shale oil here. Pioneer has an incredibly large well operation. They've got 9% of the Permian Basin, and ExxonMobil had 6%. So combining the two of those, it's like completely like US centric. It's complete vertical integration. We've got the drilling, refining, even petchem, exporting LNG, and they're this US centric absolute mega major. They're calling it now. And they're getting a bit of kind of kickback in terms of antitrust laws in the US, but I think it's about over 75% chance that it's going to go through as a deal. So it's definitely worth considering.
Yeah, I mean, it speaks to, well, bringing it back to what we do, right? I think first and foremost, it speaks to the confidence in the US production. For whatever reason, it's been a theme for a couple of years now that there is a lack of investment in the oil industry, and therefore that's going to lead to a supply crunch. But the evidence has only ever pointed to the US producing more and more. We're surpassing all-time highs yet again, and the trajectory just doesn't look like it's going anywhere. And you couple that with a high flat price environment for a few years now as well, you've got a situation where these guys are clearly looking at it going, well, we thought it was going to be volatile. We thought there was too much production, demand destruction from renewables. And, you know, particularly Chevron and ExxonMobil, they're thinking, how do we adjust our business models to survive in the long term? Now, on the one hand, I don't think they were ever not going to produce as much as they could. But the other point was they were trying to adapt by advancing their trading activities in particular. And that's been a big theme. So it's not just the super majors, not just Shell and BP who have the same vertical integrations, but fantastic trading P&Ls. That was the envy of these other majors. And, you know, Saudi Aramco, ADNOC, Chevron, Exxon themselves boosting their trading activity because it's good underlying revenue, and you actually expect it to be recurring, one, and two, probably growing if you can scale those operations, which is a great kind of diversification away from whatever's going to happen with oil. But then I think what's happened, or at least what this tells me, is, hang on a second, we've been hedging, we're doing a bit more trading. Yeah, it's kind of interesting, whatever, but we're a mega major.
Yeah. So
actually, you know, what do we know best? You know, the oil industry is not going anywhere. We've bounced back from COVID, but all-time highs on demand, all-time highs on supply, even though we're in the middle of an OPEC cut. You know, everything just looks very bullish from a production point of view. I think that what do we know best? We understand consolidation, M&A, dominating this field. So, to me, that's what it says primarily: the confidence in the market going forward, and that there's growth. And you can back that up with like a couple of your notes. Do you want to talk about like the whole concept of Guyana, right? They believe in this future production as a big part of this deal.
Yeah, looking outside of the US, so we've got Chevron looking to buy Hess, and Hess at the moment have a 30% share of more than 11 billion BOE, which is a huge amount of oil, and this is a shale equivalent. I think it's light sweet oil down in Guyana. So there's Chevron trying to get a presence outside of the US too, but in these lighter sweet grades, which are, you know, so in demand. Got high cash margins too. I know just earlier we were talking about the kind of situation in Argentina as well, where there are these really large untapped like areas of oil, and now there seems to be this kind of like arms race between all of the majors to see who is going to put themselves out there and still invest in oil and gas, and where are they going to go.
Yeah, and I saw the Guyana thing, and like honestly, I don't mind admitting, I had no idea about this place and its production capabilities. I have heard the Argentinian story quite a few times. You know, so much promise, so many reserves, but lacking investment, right? Vincent, you were looking this up?
Yes, so in South America, you have Brazil, Argentina, Guyana as having the most potential for oil production growth over the next decade. So Argentina, with their they have a shale deposit, so Vaca Muerta, if I pronounce this correctly, in Argentina's far west, holds the world's second largest shale gas deposits and fourth largest shale oil reserves.
But this has been talked about for a long time. And as Martha's saying, it's like, okay, we can talk about it and get this production going at some point, but do we actually believe it? And this is suggesting, actually, they probably do believe. Finally,
yeah, in Guyana they do, but I mean, same as you can talk about Iran or in the South China Sea having some of a lot of oil and gas reserves as well. But it's one thing to have these; it's another thing to actually develop that. But in Guyana, that's actually happening with what we can see, like Chevron acquiring Hess and all of that. Like, because
but again, the confidence, because we've had 3 years of sustained high flat price. This is the most important thing. We've been in a high price environment, which means more production because there's more confidence in these investments because you can get a yield, right? And especially looking at E&C, energy and commodities, being like one of the only areas that has performed lately against the backdrop of wider macroeconomics. Looking at private equity firms or anyone who's financing deals, this is where to put your money. And it does all kind of come together, which is not good news for people wanting to see oil production lower, because if anything, this spells like the next 10 years at least, it's going to increase. And ultimately, I think, again, it's always interesting because we're here to talk about the trading environment and how does this actually impact the derivative market, which, love it or hate it, is very, or clearly, like I just said, high flat price environment that's caused by or led by the derivative market, which has now spurred more investment in oil and gas. It's incredibly important to understand the derivative side of things. And actually, historically, another big interesting point for me is shale oil back in 2014 and before was very independent driven, and the independents would get their production licenses and get their funding on the back of hedging forward, right? The resource-based lending concept. So, they all hedged in 2014 and actually did quite well, got a waterfall from their hedging, like got good hedging returns. Thank God, right? Because they would have actually gone, well, for them, thank God, they would have been out of their job had they not hedged like they were made to. And that managed them to survive from this $100 per barrel environment we had pre-2014 to the kind of like 40 odd in 2014 and onwards. And then it just continued from there. Then it became the absolute standard to hedge everything, pretty much, it seemed, that came out of a shale oil field. And that put a huge amount of selling flow into the market. Now, if you add this selling flow, the market's got to rebalance. Either you just got to basically a depressed flat price environment, or the market organically grows around it so that the buyers can actually absorb the new selling flow. And then you just got a generally bigger market. But the buyers were probably not, there's probably been a lot of end user growth in hedging, but I would argue a lot more speculative flow has to take the hedging selling flow. And it's a bit like the gasoline markets. I've talked about this before. Gasoline market has no natural buy-side hedger that's in the professional market. So all the selling flow from producers, from refiners, has to be absorbed by speculators. Now, a speculator is very concerned about their position at all times, where a hedger is not concerned, right? They hedge and they're done. Or a good hedger just says, that's it. That's the reason why I hedged. And maybe I'll opportunistically buy it back if I need to. But, chances are you're just going to be indifferent to the price. So what I'm trying to say is, when you skew it that way, that you've added all this hedging selling flow that doesn't care about the price and absorb it by generally speculative flow, that means all the herd mentality, all the psychology that's at play is going to be in that position now. So that's what's happened. If you look at the last 6, 7, even 10 years, you basically had an increase in market volume, but a lot of it made up by spec on the buy side to absorb the sell side, on flat price at least. So no wonder we're hugely volatile. No wonder we get these hugely overextended periods, which then result in volatility and it all coming kind of crashing back down. It's really interesting for the market dynamic point of view. However, now, if you're consolidating those independents more and more, and this continues to be the theme in shale oil, not only have you got less kind of like systematic hedging, you've actually got a lot more discretionary element. And Scott Sheffield, the CEO of Pioneer, who's been bought, he was, I always used to love watching him come out and talk about the market, because he always put his money where his mouth is. He's like, no, this is ridiculous. The price should be way higher. I've reversed all my hedges. And I'm like, whoa, that is a massive long position, right? You've put yourself on the physical side. And actually, if bigger majors are buying these shale fields, then they're just worried about the general production on a much more macro term, and they've got the balance sheet to wear the volatility and all the rest of it. So you're maybe not going to get that sell side volatility. So now what happens? So short answer is I don't know with this, but I think you would expect less producing selling flow in the US. But at the same time, as I said before, these guys are all trying to boost their trading operations. And that's going to be pretty interesting.
Yeah, so speaking of trading operations, for sure, in the European majors a bit more focused on that, right? You have like BP, Shell, Totsa, Eni, but in US it's supposedly like less so with Exxon and Chevron. They're trying to be growing that. But for me, looking into the market, it always seems to be some sort of, you could say, disconnect between the oil majors, the main companies, and their trading divisions. Of course, legally they are separate entities, but of course, apart from just having the mandate to hedge the production in some way or one way or another, it feels like the trading houses are more, and the trading divisions are more speculative players instead of just doing the hedging stuff. Of course, you can see like the pricing plays, the window plays, doing the arbitrages, competing against the trade houses. But it does seem like the trading operations have become so much more lucrative, especially following the events of last year, the Russia-Ukraine stuff. Like you're seeing BP and Shell gaining record profits, but yet the trading side of things, it's relatively hush hush according to the media. It's more secretive, as in how are they making so much money?
And how is it so recurring? I think the big thing that caused an alarm was, when I say alarm, to the Exxons, to the guys who didn't used to look at trading, the Aramcos or whatever, they're saying, but you keep making this money. It's not just like every so often. Because I think that the temptation is to say, paper's there to hedge, which obviously it was historically. But I think the real kind of wonder of the derivative market we have today is that there's so much volume and so much granularity in different contracts that you're replicating the physical market to a large extent in so many different regions that you're basically able to trade exactly what you're doing in the physical ahead of time. And then you can combine the two. So when you've got, what do these guys have? Not only do they have the production, they've got the vertical integration, like you're saying, Martha, different countries, all the way from upstream, all the way downstream, and in different regions. So whilst you have that at play in the physical market, you also have that at play in the derivative market. And the thing is that from a physical point of view, if you forecast supply and demand well on the physical sense, you can be like, look, we should optimize this by sending more down to Latin America than West Africa this time, or whatever it is. But actually, you've got a derivative market that's telling you the price ahead of time right now. So optimization becomes a thing that you can do a lot better with actual executable paper trading. So you still need the physical element. I do not believe for a second that you've got these trade houses that are sitting there going, we're just the best prop traders in the world, and we just keep making billions a year prop trading. There's absolutely zero chance, right? That's hedge funds, and hedge funds, as we all know, it's a very volatile game. The ones who are the best at it, they're pretty much all systematic these days. They have, it's a very intense business model that's, just arms race of machine learning and different technologies and the rest of it. So we have to look at what you're basically saying. What is the trading revenue of these companies actually made up of? And it's the combination of the physical risk and derivative risk. So you get a physical contract, it's based on a benchmark that's settled by derivatives. You can look at things forward, you can look at things in different regions, and you have all this inefficiency. So you can start to bit part positions, and whether that's just, we'll get an extra 50 cents by setting it to this location, and let's work out the freight costs, and let's actually go and hedge that and lock it in. We've locked in an extra 50 cents that we wouldn't have got had we just stuck to physical, or at least we wouldn't have guaranteed if we just stuck to physical. And that optimization is like a really big deal, and that's how they're making a lot of the money. But then that's just like very base case. They've got things like operational tolerance, depending on the contract, the buyer or seller can choose to maximize or minimize the volume coming in, and that creates a derivative position until it's priced, right? So ultimately, if you're going to maximize production by 1% of the cargo volume, you got like an implied flat price position there. So you can trade around that, and that, again, these are all simple things. It gets much more complex, and I think the real skill is like, if you take a trader that was trading anyway in the derivatives market, and they were looking at supply and demand, technicals, whatever they were doing, positioning, flows, and going, I've got a good sense of how this market moves, and I'm kind of trading directionally in and out. And then you add, oh, by the way, here's a bunch of physical risk. So we're big exporters into Europe from the US for crude. So what that gives us is we know ahead of time that we're essentially got a WTI versus dated Brent position, or a WTI Houston versus dated Brent position. So at the end of the day, they know that they're going to be buying it from one region, selling it in another, and that gives a position of head of time that they can trade around. So they can either lock it in straight away, basically buy the WTI Brent, buy the WTI Houston versus dated, and lock in the level that they're going to send it over in the physical, or they can go, hang on a second, directionally, we really like being long dated. So why don't we not hedge the data component? We'll just hedge WTI Brent, and that will leave us long dated Brent versus Brent, which is a DFL. And that's a great optionality, right? You've been given the chance to have positions which you wouldn't have had without the physical. And if you've got a good sense about what's going on, that's a really good piece of option to have. So the equivalent for us, we're just derivative traders. So equivalent for us is like a salesperson calls in and says, this person, has a bunch of this to hedge. Now, if you're the only one seeing that flow, and you're then looking at the market right now, it's great to have those kind of incoming requests for quotes, because you might be short and losing money. God, there's no way to get out of this position. I'm finding places in the market, and then suddenly sales flow brings in a hedge. and you pay fair value for it, but actually the other side doesn't know that was great for you because you just wanted to get your position. It's not necessarily making money, it's just giving you good outlets. So do you see my point? There's a really complex like bunch of words chucked at you, but like ultimately that's why it's recurring revenue, because you're basically optimizing the current physical you have with derivatives rather than, they're not just prop trading. So I think it's quite hard for people to get their head around at these bigger majors, because they're like, no, it's all about production, it's all about physical, like, and it is, right? Yeah, their business is. So they're yet to be convinced, I think, on a large scale that derivatives actually offers them anything, because they just see it as big gamblers who get paid way too much money, which on the one hand maybe might be true in some cases, but I think most of the time it's like, no, it's about optimization, and the optimization, you need to get more and more intelligent with it. So I would almost start with a prop trader who's doing small bits and pieces but really understands the market, and then bring it all the way back to the physical and be like, if I had that risk, given what I was already doing, I'd have so many options. I could flip long short. I could, I just get such an enviable advantage. That's what they have.
Ultimately, these markets facilitate price discovery, as you were mentioning. You get calls from counterparties doing whatever. There's more buy side flow or sell side flow, depending on what product you're on as well. But it's just a combination of the physical and the paper that's gives traders so much optionality to work around that. I mean, you can also have I met some people who started off as like engineers or working refineries, and then got into middle office, and then going into trading afterwards. So you can come from a lot of different backgrounds and go into that. But it seems like with hedge funds or and trading houses, they have different trading strategies, of course, but it seems like with majors trading houses, because they have the physical, it's more, I would say, difficult to lose money, right? Because as long as you're producing something, there's a baseline revenue, and then you're hedging with that. So there's like a baseline cash flow you're receiving, and then any speculative stuff, any trading profit, you're just getting on top of that baseline. Is that?
Yeah, exactly. Yeah. But imagine a hedge fund trader needs to go in and he wants to be long equities, like S&P index. He needs to go in and buy the offer. And if it goes up, then he needs to sell the bid and that's how they make money. So there's slippage there, and they have to basically lose a bunch of costs to transactions and all this stuff based on a classic trade. And they live and die by their decision to do that. Whereas if you've got physical risk, you say, well, I'm making $1 per barrel moving this physical over to there. And on paper right now, I can lock that in and lock in that dollar. Or I can actually go, I'm going to run this position and not hedge it and maybe make $1.50. But worst case scenario, I'll just sell if it gets to 50 cents and I still make 50 cents. So imagine saying that to a hedge fund trader. Buy the S&P and you can only, worst case, make 50 cents. It's like, okay, so I only make money. You see what I mean? As in like, you're right. It's the money coming from the production side, coming from the underlying physical. You're creating these like underlying opportunities that might, you might have an edge because of financing or whatever it is, the logistics, but you translate that edge into very enviable risk reward strategies on your directional trading. Does that make sense?
So interesting with the types of looking at like the optionality and all of the different types of players, different categories of traders, and they have sort of different types of flows. So you have like refiners, trade houses, majors, funds, all employing different strategies, but they're all coming into this market. So it's the ultimate combination of you have the physical fundamental supply and demand, but also with the speculators coming in, it's a big church. It's a wide community of everyone employing all of these different agendas, which also makes the analysis
that's a great
interesting.
Point, because back to the point we were making about this, the mega majors, whatever. The more people do trade at these majors, which is happening, is a theme. The more that is basically derivative volume. So to me, it only says one thing: like derivative volume is going to get higher and higher and higher. It's a massive growth area. But yeah, no, super interesting stuff. But moving on to the refinery margins. What's been going on, Martha, with the refinery margins?
We can see there's actually a really interesting split in the refinery margins this week. This is week on week. There's been a small increase week on week, but it's all coming from the lighter products, which you wouldn't really expect this time of year, and also with the state of the market in terms of the OPEC cuts. We were seeing EBOB really lifting the refinery margin. This is coming from rubber strength and US RBOB positions being put on. So yeah, it's pretty uninspiring week over week after the significant crash like last week. But the main thing supporting it at all is the light ends and
so it's like a rebalancing of cracks, is what you're saying.
Yeah, and the EBOB strength, which is kind of dissipated into naphtha, which is a really, really weak market right now. But it's getting a little bit of that light end, it's getting a bit of that EBOB strength, which is supporting the margins. And then, yeah, loads of like exiting of positions in high sulfur, fuel oil and gas oil. Is just no interest here at all. It's been really, really low interest in the heavier stuff.
But we've been tracking this narrative quite a bit. We've spoken about it on the last few podcasts, and you guys put your trade ideas out there on LinkedIn and obviously the reports. So basically long bullish both the gas nap and the gasoline cracks. So that's come in essentially. Yeah, I like what you're saying, because it's a rebalancing. So it got to the point where the fundamentals are what they are, but the levels on the EBOB crack were clearly appetizing for just longer term traders who are looking at it on a more technical basis, knowing that at that level, seasonally, eventually these contracts will be worth more. And so you had a lot of buying coming in, and that has led to a rally. But as is the case, and I always find it super interesting looking cross barrel, is that crack goes up, okay, something needs to give way. And if it doesn't give way, then the whole margin is higher, which is very bullish crude, and then everything can rally. So it's a great indicator in combination with flat price and spreads, like what is actually going on. And I think what this is telling us is no material change to the outright refining margins, if anything, is slightly lower, but just the gasoline needed to rally because of the technical level. But then your point about high sulfur fuel is massive, because there's been profit taking. The market's been long high sulfur fuel for a long time. Why? Because all the OPEC cuts is heavy crude, and that leads to fuel cuts. So it makes complete sense that market would be tight. But if we're now seeing a reversal in that, whilst we still haven't got the OPEC supply back online, it's yet another bearish indicator really to the underlying. I mean, that's a fair point, right, Martha?
Yeah, definitely. With the 3.5 like barges, the high sulfur in Europe, I mean, we've been seeing just yesterday there's been 220k of flat price selling, and we've seen majors closing their long positions as well in quite significant volumes. Yeah. So people want out of it. The OI is really low, and the volume is just really uninspiring. So
we got to like the max priced in of the OPEC cut and the scenario. So yeah, I didn't think we'd be here again. It's super interesting, these cycles. You cut, market's bullish, it kind of comes back down again, things reset. It happened like 3 times this year. And now we're at that point again where the product market just won't give you that impetus. If the fuel oil cracks aren't rallying anymore, and the heavy market is giving way to the light end rally, that tells you, in my opinion, that everything overall, as long as the refining margin stays the same or lower, it is heading towards, there is no underlying real support in the current supply and demand balance. So I'd be a bit concerned if I was OPEC right now. However, do we get some seasonal support? I don't know. I know the power and gas guys we've got are a bit tentative. They're saying, look, everything is pointing south. Demand is down quite a bit year on year. Storage is almost full, and the only thing that could possibly be having TTF at 50 where it is right now is just because we just don't know. Infrastructure might blow out, and obviously there's the risk things going on, but that is literally the only thing. Everything else is pointing south, so it doesn't bode well. And I think, again, if we almost ignore, if we give this another week, the Israel-Palestine things, and there is no escalation in Iran or anything like that, then I think we have to kind of continue this. Well, I was saying last week, we think probably if we have to make a call, it's south now on Brent, and I think I would probably continue that narrative. You guys got a different opinion, or?
I mean, I'd say it's going south. The overall market is still bullish, but less bullish. The market is consolidating, correcting lower slightly. Bulls taking profit at the end of the year, in the money, happy days coming into December. It's time to take some profit and then start clean for next year. I think that's from a market psychology perspective, but also we're still in the middle of a cut. That potentially Saudi might extend the cuts into January. But yeah, it's very,
I think that is needed if we're not gonna dip. But at the same time, I see your point. It's that backwardated market. The spread at 120 versus being at plus 80 cents is quite a big difference in terms of cents per barrel, but in terms of what it says about the market, it doesn't really say a hell of a lot. It's still heavily backwardated. So that's kind of your point, right? It's still, even if we do get a sell-off, we're still 80s, 90s on flat price, and we're still strong on the Brent spreads. That is still a strong market. It's just less strong.
Yeah, it's still less strong. At $90, it's stronger than 70s and 80s, what we've seen from start of this year. Yet going into 100, even OPEC is Prince Abdulaziz will be changing his messaging. Demand, the jury's still out on Chinese demand. You can talk about energy inflation concerns as well, talking about the US leading up to the US presidential election. So people don't want prices too high, but nor too low. So $90 seems like a reasonable equilibrium right now.
If it can be in balance in the positioning. But I think the balance that isn't there. Like, we got a $10 per barrel sell-off in like 1 or 2 days, not so long ago. And that tells you misweighted positioning. And I think that's still there. So I still think it's skewed to the downside, and it's just about propped up in the prompt. So I think, to your point, I kind of agree with most of it. But if you're OPEC and they've got their technical meetings coming up next month, they've got their proper meetings and their new announcements of what to do next coming up soon, they probably do need to prolong this cut, in my opinion. But at the same time, it's only a matter of time. You're just kicking the can down the road, that old chestnut. But if you're not going to get the winter support, then you either need to just say, we don't want a bearish narrative forming at all, or you have to go back to the concept of, look, we've given it enough time, let's let it rebalance and go again. But yeah, once you've started this process, it feels you can't really stop. At some point, you need to let it go, and if they don't cut, it does let go. That would be that's my view. But I've been wrong before. So and ones to watch then. What headlines to watch, or ones to watch going forward?
I think just going off what you said earlier about like in a week's time, in 2 weeks' time, when everything kind of dies down, if there hasn't been some huge escalation, if the Strait of Hormuz isn't shut, then we were looking at maybe a contrarian trade with the naphtha east-west.
Nice.
Looking in December, like last week, we'd seen loads of bidding up in the Q1 east-west specifically, and the TC5 freight rates really, really high. So if we've got our counterparty dashboard up here, you can see on the right that there's been loads of trade houses opening up positions in the past, this is over the past week.
On the long side?
On the long side, yeah.
Okay.
And they've opened up these positions now, and the prices have got higher and higher. The prices are above the upper Bollinger Band. We're looking at maybe the market is overextended. And I think when there is little to come to fruition from the Strait of Hormuz, there's going to be the removal of this risk premium that we spoke about last week. And there's going to be a chain effect of shutting these long positions that these trade houses have, taking profit. They're ending the year. They're happy with their positions, their profit. And
do you think they've made money out of these positions? Do we have the average entry price?
Yeah, we could get that up.
Okay, so they bought in only on a last week, and you think that translates to essentially, almost certainly, buying into a risk premium concept for the East-West naphtha, right? And essentially saying if that's over, then that's the thing that rallied on the geopolitical risk. Once the risk is over, that's what to sell.
Definitely, yeah. So you can see here, looking at the market behavior tab of the COT dashboard, you can see that the 7-day, 3-month and 12-month average long entry price, they're all in the money.
So you think it's time now
just to keep an eye on? I think the liquidity is really good, and I think I think December was the tenor we were looking at in terms of getting the Bollinger Bands and stuff up, and it is overextended. It's just a waiting game of when they decide that they've had enough and the risk premium is going to start falling.
That's a really good one, really interesting one. The open interest ceiling at the top, that's that kind of average 5-year max open interest it gets to into pricing. And this is December contracts, so we've still got 6 weeks until it starts pricing. And it's got a bit of an open interest way to go, but at the same time, a lot can happen in 6 weeks. And like you say, if a lot of why you were buying was on the back of a geopolitical sentiment, and it's a good place to put your risk on that, then you should really sell the fact, right, at the end of the day, and that's what people have bought. So I can absolutely see the logic. It's whether or not they can continue buying and hold it into pricing and price it out strong. But I think it's unlikely given how much length is already in, and that's what you're saying. And this is, by the way, this is why I long-term view really want to get retail into this game, because you have a situation like Israel-Palestine, and you have geopolitical risk and whatever else, like Evergrande scenarios in the past and all these niche scenarios, and it's all over the news, and you're like, okay, so do I buy or sell oil? It's like, well, that's actually not the game. There's so many more options. There's East versus West naphtha, which is like, getting way into crude oil and actually processed crude oil. And you're talking about plastic demand and petrochemical demand. And there's all these things you can do and reflect your view with all these different types of contracts. So one day when we offer this, there's really exciting places to put your risk as a way to profit from these things going on in the world, and not having to just binary choose buy or sell oil, because you kind of want to do something, but you need to have access to the thing that's actually going to move. And I think east-west makes sense, because it's just increasing the chance of blockages there. If there's going to be production issues, it's in the east, not the west. So on a relative value basis, it should perform. That's what trade houses are buying into. But as you said, maybe coming to the end of that. So that's a really, I mean, you say that's the one to watch, but it's probably also a good trade idea, no? Like a contrarian trade idea.
Yeah, that's the trade idea.
That is the trade idea. It's a contrarian trade, so you've got the length in it, and the open interest is not all-time highs, as in it's not reached the ceiling like we call it, but it's still quite a bit above the 5-year average. So I would say, generally speaking, it's quite risk on. But I think your point about the long-term money, well, all the short, medium, and long-term money is in the money if you're long east-wests. That's a really key point, because that means, as we go lower, there's a lot of people who want to take profit and don't want to miss their profit. So if you do get any kind of downward volatility, you want to rush into that trade yourself and get ahead of the selling. So I think you sell a portion of your risk capital, not knowing when this turn is going to come, ride it out for as long as it takes, and in a wide stop with low volume. You see what I mean? As in, like, if you're risking just a little bit of the overall risk of the trade, you can survive it for a while. Whereas if you risk it all up front, then you could just get burnt by a continuation of the trend. And who are we to say where the trend stops, right? We don't know exactly when it's going to end. So you put a bit in, but as soon as you do see a standard deviation move, and you see the evidence, I guess, in the 7-day market trading split that people are starting to sell, there's a lot of selling to come in, and you actually know the levels, right? So 6, 4, 2 is the entry prices for the short, medium, long term. So you can kind of sell into this trade at all the levels down to like essentially $3 per barrel, because it's still at that point there's people who can sell and take profit, right? You say, oh, I've got those numbers wrong. Or either way, you see what I'm trying to say?
Yeah, definitely.
So and then you can kind of scale in on the downside, as the hypothesis being people are not stopping out, they're rushing to take profit and don't want to miss out on this trade, and the sting's been taken out of the geopolitical event. So they should all come in at once, and once you see everyone coming in at once, you try and get involved, and you sell with confidence. And that would be my addition to that great trade idea.
Thank you.
All right, cool. So thanks everyone for listening, and again, please, anything you got to add, feel free, and we will see you next week. Thanks again.